You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast.
Welcome back, everyone. Welcome back, Brandon. How's it going today?
Hey. Yeah, good. Man, we've got so much to talk about today.
Oh, man, we're not going to get through half of what we've got to talk about. And as we were just saying, we've written down, obviously, a couple of things, as we always do, but there's still things that we haven't written down.
Yeah.
One of those things was the ASX had a bit of a meltdown on, was it Monday? Did that happen?
Yeah, on Monday. It was weird. I'm reading here the Australian Stock Exchange had a technical meltdown on Monday after a major software upgrade over the weekend, forcing it to suspend share trading for most of the day, which meant that no buying or selling could take place.
Oh, man.
Yeah, it's a bit of a shambles, isn't it?
Not good if you had a big trade planned. You're a big investment fund. Oh no, what's happened?
Yeah. Share trading lasted 24 minutes, possibly the shortest trading day ever, as share prices stopped updating.
That's funny.
It's a major embarrassment for the market operator, the Australian Securities Exchange, coming just a month after its much maligned new website crashed.
Wow.
There you go.
That doesn't happen very often.
No, it doesn't. It's quite strange. Imagine like the New York Stock Exchange just stopped for every company, or the NASDAQ, it just stopped.
Yeah, that'd just be pure panic.
It would be. It'd be panic. There'd be people just raging. I don't know. Apparently there's some people potentially going to seek like legal
damages.
Yeah, something like that for things that they wanted to do but couldn't do.
I guess you could argue that, but then, yeah, I mean, how could you quantify what you lost because the markets weren't open? So I don't know, it's weird, but I think we should get into today's sponsor so that we can jump into some of these news stories.
Man, we got so much to talk about. Yeah, let's do it.
Yes, so today's episode is sponsored by Sharesight, and Sharesight is an application that I've been using over the past few years to track the performance of my stock portfolio, and it's really good for keeping track of all of the different types of gains that you have when you're investing in shares. So your capital gains, dividends. If you have dividend reinvestment plans, then it will do all of those calculations for you, which is a lifesaver. Currency gains, if you're buying shares internationally or you hold foreign currencies, currency gains, as I mentioned last week, can have a significant impact on your actual return, the real return. For example, some of the shares that I bought in March of this year have seen negative 12% returns just on currency. So if you're not tracking currency, then you're missing a big chunk of what is actually happening. So, of course, Sharesight will easily allow you to do that. And then the main reason why I use Sharesight is when it comes to tax time. So Sharesight generates up to 10 different reports that can be used at tax time to easily work out things such as your capital gains, your dividend income, and more. And at the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. You can sign up to a free plan and use it for as long as you want. And if you want to sign up to a paid plan with some more features, you can get 4 months free when you sign up to a yearly subscription when you use that link. So go check it out if you're interested.
Definitely check it out. Yep. And all right, let's get stuck into it. I mean, the news for this week is basically all 13F filings because what's the rule? The big institutional or the big money managers have to get their 13Fs filed within 45 days after the quarter finishes.
Correct.
So because it's advantageous for them not to tell everyone what they've been buying and selling because they're managing so much money and they may still very well be adding or subtracting to those positions, they generally leave it, at least the very big money managers like Buffett or Dalio or whatever, they leave it till the very last minute and then they will submit their 13Fs, which they have to do like legally.
Yes.
So what happened in the last week is we ticked over that 45th day after the last quarter ended. So now we've got all of these big institutional investors that, or just big money managers, I guess, not necessarily institutional investors, just money managers. And they have all released what they have been buying and selling in Q3 because that's what the 13F does. It discloses all of their equity positions.
Yes. And and I mean, Q3 is from the start of July until the end of September. So we are obviously looking at a past view. And as you just said, we're looking, there's a 45-day gap where we don't really know what trades have happened in the last 45 days. But it can certainly give us some insight. And for those who don't know, the 13F specifically shows us the positions that they held at the end of the quarter. And it's then from that you can compare it to previous filings to see what has changed. And that's kind of what we get to see. And of course, they all come out on the same day. So we get bombarded with stuff to look at.
Exactly.
So that's what we've got for today's episode. And we'll both be making, we've already made a couple of videos on YouTube about a couple of these, but we'll be doing these till the end of time.
Probably,
at least for the next couple of weeks.
Well, they give you so much information. I mean, it straight up tells you what the best investors in the world are buying and selling. I mean, that is you never act on it, but it's just very handy information to have, because then you can, Buffett, whatever, he sold out of JP Morgan. Okay, well, let's go and see why might he have done that. Okay, we know how he invests. We know how he goes about his investing. Why did he do that? So,
yeah.
And speaking of Buffett, that is the first investor that we're going to talk about, I guess. Warren Buffett, obviously, Berkshire Hathaway's 13F. They've got about 50 or so stocks in their portfolio, I believe. Right. So that they do hold a fair few stocks. So we're obviously not going to talk about every single little thing that they did with each position. But I definitely I found three key points that came out of Warren Buffett's 13F. And probably I would say the most impactful, I guess, would be that Warren Buffett is reducing his positions in most of the US banks. Wow. So he's basically selling the US banks or the US financials, except for Bank of America. So, I mean, he must love Bank of America for some reason. But in Q3, he added 9.2% to Bank of America. So that position is worth 10.6% of his portfolio. So it's quite a sizable position. In fact, I think it's their second largest position behind Apple.
Right.
So that's still quite a decent position. But then when you start looking at some of the other bank or financials, for instance, he reduced 46% in Wells Fargo. So now that's down to just 1.3% of their portfolio. He reduced 35% in M&T Bank. So that's 0.12% of their portfolio. Reduced 64% in PNC Financial Services. That's 1% of their portfolio. And like I said before, he reduced 95% in JP Morgan. Ooh. So I reckon he would have sold out of that by now, because it's only 0.04% of his portfolio.
Yeah, you would imagine with that one that in the last 45 days that we can't see yet, he probably sold the other 5%.
The last couple of shares.
I don't think Warren Buffett's the kind of guy who would sell 95% and then hold on to 0.04%.
Yeah, exactly.
Doesn't really make any sense. But it's interesting that he sold out of all of those banks, but then he's put a considerable amount more money into one. So yeah. I'm curious to I hope we get an interview from him at some point where he'll kind of explain his rationale behind this, because obviously he still sees something in the financial sector, but he's no longer, I guess, broadly bullish on the financial sector, I guess.
Yeah, exactly.
But I guess we don't really know. Yeah.
Yeah. Yeah, no, exactly. And this is a theme that is not new for Warren Buffett. This has been happening for over the past year or so, that Buffett has been reducing his exposure to the US financials, just generally. Like, a lot of these positions were worth, 1, 2, 3, 7, 10, 12%. Just a year ago in terms of percentage of Berkshire's portfolio. And now they're down to 0.12%, 1%, 1.3%. Even Bank of America's down as a lower percentage versus last year, 10.6% versus I think it was 12 point something percent. Right. Overall, yeah, he's definitely, over the last year or so, he has continued to reduce exposure to US financials, but has stayed relatively bullish on Bank of America. But yeah, so that's the first point, I guess, of Buffett's 13F that I took out of it. The second point, which was quite interesting, is that he bought into, so these are 4 new buys, so he didn't hold these shares before. He bought into 4 pharmaceutical companies.
Wow.
And so the companies are Merck, AbbVie, Bristol Myers Squibb, and Pfizer. And it's kind of interesting. I'm not really too sure what to make of this, because I was trying to read up on some similarities between these companies. Maybe he's found something that each one does that he really likes, and he's backing all the players in that area of pharmaceuticals. But not really the case. They all kind of do different things, which is kind of strange. But the weirdest thing is, and the thing that I can't really quite figure out, is that the first 3 positions, so Merck, AbbVie, and Bristol Myers Squibb, they are all $1.8 billion. All 3 of them. Each position, $1.8 billion each. So each one of them takes up 0.8% of the portfolio. Now, to me, that sounds like a diversified play on a particular sector. Kind of like how you remember he bought into those Japanese trading companies, and he kind of sunk couple $1 billion into each one, kind of thing.
Yeah.
Kind of sounds like that, because I mean, if Buffett's bullish on particular companies, he won't necessarily invest the same amount into each company. It's not like he's going to invest, $10 billion into Bank of America and $10 billion into Apple, and then, $10 billion into Merck or something like that. Yeah. Usually he just allocates the capital as he sees the opportunities. But these 3, it's just bang, 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 $1.8 billion in each, takes up 0.8% of the portfolio each. And then the only one that's different is Pfizer, which is a much smaller investment, which is worth $140 million. So I'm not even sure if that was Warren Buffett.
Right. Yeah, that's really small.
Yeah.
Although that's probably the one that's paid off the most, considering
potentially
the news that we have out of Pfizer. Did you see the full results for Pfizer's trial came out today as well? It's another thing we don't have time to talk about. But
did you have a read?
They were 95% effective, so even more effective 95. than they originally thought in the interim results.
Fantastic.
But that's all I read. And we probably don't even have time to talk about it. Well, that's still
some really good news, isn't it?
Yes, it is. Yeah. So I think Pfizer was up on that news as well. But yeah, it is certainly very interesting that he's kind of done a couple of these trades now where it looks like he's betting on a group of businesses or a sector. And I think it was, who else did a trade like this? I think Seth Clarkman, who invested in, I see this kind of the same way, who invested in Facebook and Google, kind of just making a play basically on the digital advertising space rather than picking one versus the other. So yeah, it's an interesting move. I get that. But overall, I guess still a very small part of the portfolio. So it'll just depend whether that's kind of the start of something big, or whether it's just going to stay a small piece, and maybe it's one of the other money managers that are in control of those investments. I don't know.
Yeah, I'm not sure. It could very well be, because I remember hearing that both Todd and Ted have $10 billion each, but I think probably over time they've grown that, so they probably control more capital than the $10 billion now. So maybe it was one of those guys, but I mean, that would be a significant, if that was like one of them, that would be a significant portion of their portfolio still. It'd be like nearly $6 billion, $5.5 billion into pharmaceuticals. But and then so that's the second thing, which is a little bit confusing for pharmaceutical buys. I can't quite figure that out. Let us know if you guys have an opinion on it, what you think Buffett's getting up to there. And then the third takeaway is this is actually the largest move. The most impactful move on the portfolio this quarter, and that was that Warren Buffett is trimming his Apple position. I think he trimmed it, 3.7%, which actually means quite a big change in their portfolio, because Apple takes up like 48% of their whole portfolio. It's
they have so much money in Apple. It's kind of ridiculous. Yeah, it's funny that they trim like 3% of it, and it's the biggest move that they've done for the quarter. But yeah, I thought this was really strange, and I actually made a video on this that came out today while we're recording this, so that's Thursday. It's already out. Because it was only a few months ago in April where Buffett was talking about the sale of his airlines, and he basically said, we don't trim positions. Like if we're ever selling a position, we're going to sell completely out of it. And that was kind of interesting to me around Apple. And I personally, I don't think that he's probably going to be selling any more Apple. I think he probably is just trimming it, but it's interesting to kind of contrast that, because I think it was in April when we first found out that he was selling a little bit of the airlines, and we spoke about it on a couple of podcasts. No one really knew like whether he was going to sell out of them or whether he was just getting underneath the 10% reporting requirement. Like everyone was kind of like, what's going on? I think he sold 4% of Southwest or something like that. And then like a couple of weeks later, we found out that he sold completely out of them. And it was then that he said that he doesn't trim positions. So very interesting. I personally, I think it's probably more likely that they did just trim the position and that he's just going against what he said a few months ago. But it's interesting to see. But I spoke about in that video how many things Buffett has done this year that kind of go against what he said in the past. I mean, he invested in a gold company. He was a net seller during the biggest crash we've seen in 10 years. Then he sold out of the airlines, and he's trimming a position that he said he wouldn't trim. So I don't know. It's very interesting.
I think it kind of shows you that, while we like to follow this investing strategy that, seems like it should be step by step and we follow all these rules, at the end of the day, investing is quite, malleable. You kind of have to mold it and squeeze it around a little bit. And it's not kind of, you can't just have this checkbox checklist that you just tick, because there's so many individual factors with every company or every sector that, and sometimes it does pay off. There's another factor, which means, okay, maybe you do need to trim or something like that. I mean, it's the same thing like with Phil Town. He got criticized because, so much of his books is talking about how he doesn't like to invest in companies that have uncontrollable debt. And then he goes and he sinks heaps of money into Boeing. And Boeing have got like so much debt, it's ridiculous. So
yeah, I think
it was Boeing. Was it Boeing? I'm pretty sure it was Boeing.
Yeah, I think it was. Yeah. I can't remember who said this analogy, but some famous investor said that investing it's not a science and it's not an art. It's kind of a mix of both. It's kind of like cooking, where you have a recipe, but really good chefs kind of work with the recipe. It's not as if, if you have never cooked something really complex, even if you have the recipe, you're going to mess it up. So there is a recipe, there is kind of a science portion to it, but there's also just while you're cooking, while you're investing, you need to, like you said, it's a little bit malleable. There's a little bit of wiggle room in your strategy. So very interesting.
Yeah. Yeah, but I definitely think that this is quite a strange. This is another one that's kind of bit of a question mark. What Buffett's doing here, because I reckon, like, to me, I'd probably bet that he is just trimming it, but that does go against what he normally says. Because I mean, the thing is, it's flipping 48% of his portfolio,
and it's up so much.
Yeah, I don't think, maybe he is just kind of just subtly kind of clear. Maybe he thinks it's really overvalued right now, so he's just kind of clearing it. But even that's not really Buffett mentality, to clear shares off the table when, or to sell some of your stake when the shares are overvalued. That he doesn't really do that.
No, he doesn't. So, yeah, these days, if it's a great business, he's generally just holding on to it regardless of what the price, because it's just too hard to get in and out. Like, he's not going to sell Apple and then buy it back in 2 years. That's too expensive, and wouldn't even be worth it. It would just be better just to hold on to it once you're that size. So yeah, I don't know. I mean, as always, we'll kind of see what happens as it unfolds. The other thing, I was looking through the other 13Fs, and he also trimmed Apple in the fourth quarter of 2019. So like basically same time last year. He trimmed a similar amount, about half as much. So it's not the first time that they've trimmed Apple. So
maybe he trims it towards the end of the year so he can pay for all his kids' Christmas presents.
How much was it? Like $5 billion or something? Here, kids.
Probably.
Go wild.
Kids, you're getting a private jet for Christmas. Actually, you're getting several private jets.
Yeah.
Anyway, so that's Warren Buffett's 13F.
Yes.
Shall we move on? We'll talk about another investor's 13F.
Yeah,
Should we do Dalio, Bridgewater, or should we do Klarman?
Let's go Dalio, and then we can go Klarman. Yeah.
Dalio.
Yeah.
Okay, so this is I guess it's Bridgewater's 13F.
True.
Bridgewater Associates, largest hedge fund in the world, right?
I think like 140 something billion dollars under assets under management or something like that.
Huge, yeah, a lot of money that they're dealing with. And interestingly, I should say up the top of this segment that when we're looking at Bridgewater's 13F, their portfolio size is only like $8 billion out of the $140 billion that they control. So it is it's kind of worth noting that most of their money is not in their, I guess, equity portfolio. I guess a lot of money is in bonds and the like.
Yeah.
But with that said, again, we had 3 kind of points out of Buffett's 13F, and we've kind of got 3 points again in Bridgewater's 13F, or Ray Dalio's 13F, I guess. And the first big takeaway point that I took out of it is that he's pumping a fair amount of money into the emerging markets and also into select Chinese businesses. For example, so he put plus 13% to the Vanguard Emerging Markets Index Fund. He tripled the position in the iShares MSCI Emerging Markets ETF. So he's putting a lot of money into those emerging markets, those emerging market ETFs. He also added 40% to Alibaba, 20% to JD.com, and 47% to, I don't even know how to pronounce this one, Pinduoduo. But those 3 are essentially the large 3 e-commerce companies of China. They're kind of like the Amazons of China.
Right.
But interestingly, while we see those big and there was a few more, I can't remember, like Baidu and some other companies.
Yeah.
While he was adding quite substantially to those individual businesses in China, and he was also adding to the emerging markets index funds, the China-specific ETFs that he actually reduced quite substantially. I think he was reducing like 20 to 40% in the China-specific. Like there's a China large cap ETF that he trimmed down quite a bit.
Right.
So I think that just tells us that, yeah, he's still very bullish on the emerging markets, which is not just China. But he's also, when it comes to the Chinese portion of the portfolio, he's switching it, or Bridgewater is switching it a bit more to active management as opposed to ETF style passive management.
Yeah, that's interesting because I think, and I maybe I don't know if you have this up, but in terms of what are the percentages that like Alibaba is of the portfolio, but yeah, typically Bridgewater has been very much ETF index based, so it's
and they still are. Yeah,
and they still are. Yeah, it's a good point. But yeah, it's interesting to see that in at least in China, it looks like they're going a little bit more narrow, but emerging markets wise, they're going quite a bit heavier. Very interesting. Yeah, I'd wonder. I'd like to see, and I haven't looked into Bridgewater's numbers yet or anything, but I do know that they work a lot on. They do a lot of portfolio balancing, so making sure that certain percentages, certain sectors meet certain percentages. So I'd love to see kind of what portion of this is kind of just rebalancing that maybe the emerging markets haven't done as well and they're topping it up. I don't know. I haven't looked into it yet. That'll be one for me to look into next week.
Yeah, I'm having a look at it right now. So let's order their by current value. So yeah, like Alibaba is their 4th largest holding.
Wow.
JD.com is probably down at, maybe that's like number 15 or something like that. But yeah, you're right. Like if we read from the top, it's the SPDR, S&P 500 ETF, then the gold ETF and the emerging markets ETF. So it's very much the gold trust, another S&P 500 ETF, another emerging markets ETF. Like most of the top of their portfolio is just held up in ETFs. But I think they've got 2 types of funds, right? They've got their pure alpha fund and then they've got their all-weather fund.
Correct. Yeah.
And I think the pure alpha is I think their goal there is to try and have it almost perform. It's kind of like any like listed investment company. Try and have it almost perform the same as the market, but outperform it slightly through clever active management positions.
Right.
So that's where I think that they do introduce some of that active investing. But yeah. Overall, definitely the first takeaway. Sorry, I've got to get back to where I was. The first takeaway was that definitely they're putting a lot more into select Chinese stocks, not so much just passively investing in China, and also adding to a lot of emerging markets. The second big takeaway, when you're looking at what they're doing over in the United States, it is all just consumer staples or consumer discretionary. Wow. They're just completely defensive. Like for instance, some of the stocks that they added, these are new buys, right? New buys for the quarter. They did not hold these stocks beforehand. Walmart, Costco, they did hold Costco before. So Walmart, Pepsi, Coke, Monster Beverage, Johnson & Johnson, Kimberly-Clark, Colgate-Palmolive, Procter & Gamble, McDonald's, Chipotle. So, I mean, you think about those, like what do those stocks have in common? They're the companies that continue to generate revenue no matter what's going on in the economy. We could be in the best economic time ever or the worst, and those companies still bring in very healthy revenues. They're the consumer staples. They're the consumer discretionary type stocks that just keep generating lots of revenue.
Big brand names that everyone recognizes that don't see too much of a change given the economic conditions. Yeah.
I think I was reading somewhere, you were talking about how they do a lot of moving and shaking depending on, just to rebalance and restructure the portfolio. I was reading that it's a lot of computer algorithms too. Like for instance, I think they were saying that like a computer spat out that they should be investing in Walmart, and it's a new buy, and it's 1, 2, 3, 4, 5, 6. It's the 7th largest position in their portfolio, and it's a new buy. It's just like bang, straight in, 7th largest.
As soon as you said that,
Procter & Gamble is 9th.
Yeah. Sorry. Yeah, I was just going to say, as soon as you said that, a computer spitting that out, I just remembered that the original Charlie and the Chocolate Factory, where they have that machine and then it like spits out where the chocolate bar is on like a piece of paper, but it doesn't work.
Yeah,
Do you remember that scene? Just imagining. Beep, beep, beep. What should we buy? Walmart.
Yeah. Yeah, exactly right. Walmart comes out of the machine. No, it's pretty funny. But yeah, I mean, the new ads here are just totally defensive stocks, all weather. I guess it makes sense. I mean, half of their fund is called all weather, right? So it kind of makes sense that these all weather stocks are kind of being included. But they also they did add to Costco, they added to, Starbucks, they added to Target, they added to UPS. So more of those kind of consumer staples or discretionary, like the ones that just they get used and abused all the time.
Right. Okay.
All right, should we move it? And then, so that was kind of the second thing that I took out of the Bridgewater 13F. And then the third thing, which was interesting, is that they're actually cutting back on the S&P 500.
Wow. Okay.
So again, not sure if this is like a rebalancing or whether they want more active management out of their US-based investing. But if we look at the top of the chart, their biggest investments in SPY, and they reduced that. So that position was worth 1.5 billion. It's now worth 1.3 billion. So they reduced 21% in SPY, which is an S&P 500 ETF. But then they also hold They hold IVV, which is another S&P 500 ETF, and they reduced that by 63%.
Whoa!
So from $500 million down to 200. $500 million down to 200 million. So.
Oh my goodness!
Yeah, I don't know.
How much do they have in that first SPY ETF? Is that
they have
most of
1.3 billion.
Right. Okay.
Currently,
so
they did have
the big one.
1.55 billion.
Yeah. Okay. Wow. That's still a big reduction in what you would imagine is most of the time their biggest investment, and is still their biggest investment in their portfolio. Very interesting.
I don't know. Interesting kind of takeaway there. I'm not quite sure. I guess it's just they want a little bit more active management. They maybe don't. They're not so bullish on the S&P 500, which remember is 500 businesses. Maybe they just want more of those defensive kind of stocks.
Yeah, it seems that way. All right.
So anyway, that's all I had for Bridgewater.
Yeah. Should we can move into Seth Clarkman now. someone who invests very, very similarly to Warren Buffett, a younger Warren Buffett, many people say. So I made a video on his 13F as well earlier this week, but I went specifically into one of the investments that he made, which I'll talk about at the end because I think that's probably the most interesting thing out of this. But there was obviously a number of different moves that he made throughout the quarter. His biggest position in eBay, which was originally or at the prior quarter was about 20% of the portfolio. He reduced that by 6%. So that's now 17% of the portfolio. So a little bit, he's kind of trimmed that position a bit, but that's probably because eBay has gone up so much recently. So seems like he's just kind of doing a bit of trimming there. Another one that he added 18% to his Viasat investment, which is now 6% of the portfolio. And that is a US-based satellite broadband company that I don't really know anything about.
No, me neither.
But that, it's one of his major positions. He added to his PCG position by 551%, which seems crazy, but it was a very, very small part of his portfolio before, which is why that is kind of inflated.
So high.
But it is now 3% of his portfolio, which is not...
That's decent.
Yeah, it's not insignificant. And for those who maybe a couple of people will remember Pacific Gas and Electric, they filed for bankruptcy in 2019. They were the company that were found to be the cause of the 2 really bad bushfires in California in 2018, I believe it was, when those fires were. That company was in bankruptcy, and then they got out of bankruptcy. Obviously, I think someone must have bought them out or something like that. And I guess this is a bit of a turnaround play for Klarman.
Yeah, clearly, yeah.
Yeah, and a couple of other moves. He initiated a position in Micron, which is now 2.7% of the portfolio. He reduced his Google and Facebook positions, which were a big part of his portfolio earlier in the year.
He had a big bet on those ones.
He did, yes. So in Q1 of 2020, they were a combined 10% of his portfolio. So he was basically making 10% of his portfolio was a bet on the digital advertising space online.
And there's only 2 stocks that occupy more than 10%. There's a 12% position and a 17% position. So there's eBay and Liberty Global. So that is like a significant chunk, would have been a significant chunk of his portfolio.
Yeah, no, definitely. And I mean, he has his eBay position. He used to have his Facebook and Google position. And then the rest of the really top, the big positions at the top are all communications businesses. They're all either like a satellite television network or broadband or something like that. So he's very concentrated in that space. But yeah, in terms of Facebook and Google, he reduced Google by 28%. And Facebook by 33% in the quarter, bringing those positions down to a combined 4.1% of the portfolio. Right. So a fair bit smaller, but still a decent chunk of the portfolio. Both of those businesses have done very, very well over the past few months. So
I reckon he'd still be bullish. I just reckon he's just realizing that how much money he's made and just taking some of that money, considering they're pretty overvalued.
Yeah, and he was buying for the first time in March. So he was buying when these stocks were down 30% or 25%. And now they're well above the price that they were pre-pandemic. So he's made probably a ton of money on those investments. And I'm, as a value investor, I'm sure it's not too difficult to argue that Facebook and Google are overvalued at this point. So kind of makes sense to see him reducing those. But I think the most interesting thing out of Klarman's 13F was his investment in a SPAC. Special purpose acquisition company. So this is what I spoke about in my video, and I didn't know I'd heard of these before. I'd spoken with a couple of the students in my group about this before.
We actually have a Q&A question about SPACs.
Oh, do we?
As well.
Okay. Well,
yeah, did you see? You didn't see that?
No, I haven't seen that yet. So maybe...
So this, hopefully we can cover this question now.
Yeah,
the question was, what was it? Is there any instance where you would seriously consider investing in a SPAC?
Oh, okay.
That was the question.
Yeah, okay. Well, maybe we'll answer it in just a sec. I'll go through and explain kind of briefly what a SPAC is so that people know, have some context.
Definitely, because I've never really looked into SPACs.
SPAC. It's got a funny name.
Sounds funny.
Yeah.
SPAC.
Yeah. So, so a SPAC is just short for Special Purpose Acquisition Company. And basically, it's not a typical company. It doesn't have products or services or operations. The whole purpose of the company is to just raise capital, to raise money. And then for that company, that SPAC, to then buy a private company and take it public. So it's kind of like an alternative way for a private company to go public rather than just traditionally selling their shares directly to the public.
Right.
And interestingly enough, SPACs are actually illegal in a lot of countries. Not in the United States, obviously, but
right. Can I just sorry, because I don't really know how this works. So is a SPAC a publicly listed company? Do they form a publicly listed company and then they use that publicly listed company to buy a private company?
Correct, yes. So this SPAC, for example, is called Pershing Square Tontine Holdings. They went public in July and they raised $4 billion. So investors invest in this SPAC and basically shareholders then don't even know what company they're going to be acquiring. Yeah. It's basically up to the person who's running that company to make an acquisition. But the acquisition is unknown at the time of investing in that SPAC.
So it's like investing in an IPO of nothing. And then that company will use that raised money and buy something else. Is that right?
Yeah, exactly. And I think the most logical way to think about it is you're basically passing your money off to a big fund manager to make an investment decision for you. It's kind of like, hey, I've got $5,000. Can you pick a private company to buy for me because I can't access the private markets and I don't want to invest it in any other business, but. Yeah, that's kind of how it works. And in this circumstance, as I said, it's called Pershing Square Tontine Holdings and it's run by Bill Ackman. So he's the investor who will be making the acquisition decision. And they raised $4 billion. And then Ackman is going to be contributing between $1 and $3 billion, which means they'll have a total of $5 to $7 billion to make an acquisition. And Ackman said that he's looking to buy a company that's worth 10 to 15 billion. So basically buy like 30 or 50% of a company and then take that portion of the company public. And then as a result, the investors in the SPAC would become investors in the company that they acquire. And this was the biggest raising for a SPAC. It's the biggest raising for an IPO this year, and it was the biggest, I think so, and it was the biggest SPAC of all time. So it's got a lot of attention, and as a result, there's a lot of people obviously speculating on what he's going to buy. So there's a couple. Airbnb was an early one that a lot of people thought, but apparently they failed to reach a deal. Stripe is another one. Bloomberg, they're still in talks. I think Stripe fell through. I think that's what I read, and Bloomberg is still in talks. And another one people think is Robinhood, but I think Robinhood's probably a little bit too early because Ackman said that he wanted to find a mature private tech company. So a tech company that's been around for a while, something like a Bloomberg, for example. But Robinhood, I guess, is on the table. Some people would like to see that. But that's kind of the situation at the moment. And in terms of Seth Clarkman coming back around, he invested $400 million into this SPAC. So it's a big bet. How big was Seth Clarkman's portfolio? I think it was $9 billion was his total portfolio. So that would mean
9.2.
This SPAC would be about 5%, if I've done maths correctly. Yeah, a little bit less than 5%. Roughly.
Yeah.
So
there you go.
Yeah.
Oh, that's very interesting. So let's follow this. I'll be very interested to see what this SPAC ends up buying. I guess if they don't have enough, what happens if they don't have enough money to buy what they want to buy?
Yeah, so it's set up like a trust, so it has kind of rules, and this one in particular has a 2-year time, I guess like a timer. So after 2 years, if they can't find an acquisition, the money is returned to shareholders at the IPO value. So that's kind of what happens if they don't find a deal.
They disagree, like we'll put what was it total, like $5 to $7 billion in.
Yeah.
We'll try and find something. If it doesn't work out, we'll just get our money back.
Yes, correct. Yeah.
Okay. Yeah. No, very interesting. We'll have to follow that and see what happens. But yeah, interesting moves by Mr. Klarman.
Should we answer that Q&A question just briefly, just to?
Yeah, well, I think, would you ever invest in a SPAC? Well, to be perfectly honest, by the amount of questions I was just asking, I think I would have to do a lot of research to fully understand what was going on. I don't even know. Can you can small investors invest in SPACs?
Yeah.
I don't quite know.
Yeah, I mean, it's just a publicly listed company. What I said in my video...
Oh, yeah, of course.
What I said in my video was... I don't really like that you don't know what company they're buying and what price they're paying for the company. It's kind of a blind investment. But and the other thing is that I think the only way that I would invest in a SPAC, or the only reason, would be if it was run by someone I really, really believed in as an investor, which is not Bill Ackman, but someone like a Charlie Munger or Warren Buffett, which... I mean, I very doubt that they're going to be doing a SPAC, but if they were to do one, that would probably be the circumstance in which I would do it. But Bill Ackman, I don't like some of his investments in the past. So,
no, I definitely don't like some of his investments in the past. Did you watch that episode of Dirty Money on Netflix?
I mentioned that in the video as well on Valiant.
Oh, did you too? Yeah,
shocking.
Yeah, man, he's done some dodgy shit in the past. By the way. Off topic, I would highly recommend watching that series on Netflix if you're interested in when companies do bad things, when their pursuit of making more money turns sour, and they do dodgy things. It's very interesting. I mean, there's an episode on Volkswagen. I think that's the most interesting for me anyway, and how they, instead of changing their engines to emit less nitrous oxide and CO2, they actually just put a cheat device in their tailpipes. That was a few years ago. That happened. There's one on Donald Trump and his ventures into Atlantic City casinos. There's the one, with what was that pharmaceutical company that Bill Ackman got around? This
Valiant.
is why we don't like him very much. Valiant, that's right. Where they jacked up the price of life-saving pharmaceuticals by, like, they made some medication costs like over $300,000 a year or something like that.
Yeah, and they had like fake companies set up, fake pharmacies and stuff to hike prices.
Yeah, that's right.
Very, very dodgy.
So there's so much dodgy stuff going on, and it's a very interesting series, and I would highly recommend it. Just give it a go. I reckon. What one's your favorite out of the ones that you've seen?
I think probably the Valiant one. Because the Valiant one...
The Valiant one.
Yes, yeah. I think because that was the one where they kind of followed the investors who shorted Valiant stock.
They did so well.
I think, they did so well. And I mean, when they first initiated the position, the stock just kept going up. And no one really kind of believed it was happening. And then it kind of all fell to pieces. So that was probably my favorite one.
Yeah, I really like the Volkswagen one, just because climate change is my thing. So
yeah, I haven't seen that one, so I'll have to.
Definitely watch it.
Yeah,
definitely watch it. It's crazy what Volkswagen were doing. Holy smokes! Anyway, let's move on because we've still got some more stuff to talk about. I think we might leave this second Ray Dalio discussion point for next week.
Yes.
Do you want to do that?
Yeah.
We'll move on to something that's very pressing this week. Finally, some good news for Boeing. So the US, here's the what the article reads: US lifts Boeing 737 MAX flight ban after longest grounding in commercial aviation history.
Wow.
So there's some good news. So the US government has been given the green light for Boeing's 737 MAX to fly again after the fatal crashes in Indonesia and Ethiopia, which killed 346 people, halted flights 20 months ago, starting a lengthy process for clearing hundreds of grounded jets as the plane maker faced criticism from victims' families. Man, what a big news story that was at the time. And unfortunately for Boeing, I mean, they've just add insult to injury with all this COVID stuff. I mean, they've had their big new plane has been grounded because it's a couple of crashes, and then cop that. There's also no one that's buying new planes for a little while because of COVID, obviously. And overall, I was reading the overall cost they estimate to Boeing, this whole crisis, is $20 billion. Cop that. That's just rough. That's so unfortunate. But then again, I mean, fair enough, because I mean, they were flying planes that were killing people. So
yeah, it's a perfect example of that saying, when it rains, it pours. It's like whenever something bad happens, it all comes at once.
It all comes crashing down, doesn't it?
I remember the first time that we did this news story on the podcast was that live episode in Melbourne, the first one we ever did, I think. So that's how long ago it was. Must have been episode 50, I think, of the Young Investors podcast. So there you go.
There you go. That is a while ago now.
Yeah.
We've doubled our business since then. US Federal Aviation Administration, the FAA chief, Steve Dixon, said they had done everything humanly possible to ensure these types of crashes did not happen again. He said he was 100% confident in the plane's safety. Boeing shares, they didn't really move. They're up 1% on the news. It says here, when flights resume, Boeing will run a 24-hour war room to monitor all MAX flights for issues that could impact the jet's return.
Oh, God.
From stuck landing gear to health emergencies, they're going to monitor this plane like very, very, very closely.
Scary stuff. Yeah. Because it was their biggest product as well at the time, I think, right? Everyone was buying these 737 Maxes.
They all had the orders in.
Yes.
They had a big backlog of orders. Yeah, exactly right.
Like it wasn't some like obscure plane that a couple of smaller airlines were buying or something. It wasn't
like a little Cessna or something.
Yeah, exactly. Like a little propeller plane.
Yeah, exactly. No, this is a full-on workhorse of the fleet, I guess.
Yeah.
But now I just guess they just need some people that want to fly.
Yeah, it's going to be
so that airline companies can make some money and they can actually pay for the orders of these 737 Maxes.
It's really bad timing, because there's going to be that we're already seeing a lot of consolidation in the airline industry, where some airlines are going bankrupt, other ones are buying them, and then they're just reducing their fleets as a part of that process, get some more cash flow. We've seen that Virgin has done that with some of their smaller airlines, and the demand just snapped for buying these new planes so quickly. So I wonder how long it'll be curious to see. And I say this on every podcast, every section, but it'll be very interesting to see how long it takes to come back. Like, will people just go back within the next year, or is this a 5-year rebuilding thing, or do people never go back to flying at the same levels that they did? I don't know. And
that's an interesting thing about Boeing. You can argue that they have a competitive advantage. You can argue that they have a moat, and you can argue that they have an anti-moat, because their moat is obviously that they are one of the two big aircraft producers in the whole world, and so many of the planes that fly in the skies these days are just Boeing planes. They have a huge kind of barrier to entry moat, I suppose.
Yeah.
But they also have the anti-moat in the fact that they are reliant on select few businesses to buy their product, because I'm not going to buy a Boeing product. Apple, Netflix, McDonald's, they're not going to buy a Boeing product. They're the only companies that are going to buy a Boeing product are there's only maybe 10 or so, maybe 20, 30, 50, airlines. And I guess that's one of the things you got to consider, which usually you wouldn't even think twice about, because obviously pandemics don't happen every day.
Yeah.
But they've also got the anti-moat in the fact that it's not a widely, widely consumed product. It's very niche, can only be bought by a select few companies. So anyway.
Yeah, it's a really interesting point, actually. It's very, very different economics to something like a Coca-Cola, that has everyone can be a customer, basically, anyone of any age, and you're a repeat customer a lot of the time. Very, very different. It's like two ends of the extreme. Very, very interesting. Yeah.
But anyway, that's just a thought that popped in my head. So good luck, Boeing. But thank goodness, finally, Boeing has sorted out the issues and they've got the FAA back on their side. So good job. Last news story, I guess. Then we'll maybe squeeze in a Q&A question or two. Tesla added to the S&P 500. Woohoo. So this is very interesting because it was supposed to be, well, it wasn't supposed to be, but it was eligible to be added last quarter, but they decided not to add it to the S&P 500. I think there's like a board or there's like a group of people that meet and decide who's in the S&P 500 or whatever. But they didn't include Tesla, even though it met all the eligibility criteria. And their reasoning at the time was that they just wanted to make sure that the spike in share price and thus the spike in their market cap that would cause Tesla to go into the S&P 500 was something that was going to be sustainable. And it wasn't just a short-term kind of like a Bitcoin where it goes up, but comes down kind of thing. And then, well, look, they add it this quarter and they take it out the next. But this quarter, they have decided that Tesla is worthy of S&P 500 inclusion. And they're actually wondering how they're best going to add Tesla into the S&P 500 because it's such a large company. They're debating whether they do it in just all at once or whether they actually split it up over two tranches. So they add like half of Tesla in and then add the other half of Tesla in at another time.
What?
Because as it's they're debating whether they add it in just in multiple tranches. Because if you just add Tesla in right now, it's already in the top 10 holdings of the S&P 500 based on its current market cap.
Wow.
How crazy is that?
That's insane. That's crazy. Wow. So I mean, that would be a lot of money flowing from index funds, you would imagine.
Yeah, exactly. Exactly. Feel sorry for the company that's getting kicked out of the index because here comes Tesla. In it comes.
My goodness.
But yeah, I don't quite understand. Yeah, two tranches added into the S&P. I don't get it.
I don't know. Yeah, how do they do that? That's really strange. And I
don't quite understand either.
Yeah, and I guess does that mean that the overall size of the S&P 500 would go up substantially as well? Because unless they're removing businesses that are equally as big, which I don't think they would be, considering Tesla's so big.
No, they'd be kicking out the small little 500.
Yeah, get out of here.
And then they're adding a top 10.
Yeah, so it would be...
Which is insane.
It's just a bigger portfolio then. Which is very strange.
Yeah, exactly.
I don't know. Yeah, I've been thinking about this a little bit about what's going to happen, and it'll be interesting to watch because I would imagine, and it's kind of already happening, right? That the stock's up 17% this week and it's up 500% for the year, which is insane when I just looked at that. But you would imagine that in the short term,
it went up 10% overnight.
Yeah, up 10% overnight. You would imagine that in the short term, that it being added to the S&P, it would have a positive impact. You wouldn't think it would have a negative impact being added. Maybe neutral, but you would probably bet on it having a positive impact. But I don't know about like over the long term. Like how long does that last? How long does that impact last?
Is it like an instant thing?
Yeah. Is it like right now because everyone knows it's going in the S&P, it just gets bid up straight away, and then it trickles down over time as the impact kind of wears off? Because you would imagine that over the long term, the share price would go back to reflecting the value of the cash flows the business produces, and not have this arbitrary added percentage just because it's in the S&P. But maybe it does. I really don't know.
Yeah, me neither. I'm not sure. Anyway, that was just a quick news story. I think I just added that in because it's quite interesting.
Yeah.
Interesting to see how it all works. I've not followed a company getting added into the S&P 500 before.
Me neither.
I didn't even know that there was like a group of
little
people
committee
that sit down and decide whether it goes in or out. I just thought that, it's the 500 biggest companies. I mean, there shouldn't be any debate about that.
Yeah.
But apparently there is.
Yeah, I didn't know. I was not aware. Well, I was aware of it like this year, but when I got started, I wasn't aware that they had to be profitable. And that, there was all these other criteria. I just thought that it was the 500 biggest, highest priced companies. But yeah, there is a criteria.
Anyway, we should move on. Let's do one Q&A question. We've got so much to cover in this one that we've just got no time left. But speaking of Tesla, here's a Q&A question that I did want to chuck in.
Yep.
And this question is, have you guys looked into ARK? So ARK Invest. Kathy Wood seems incredible. There have been, they have a few ETFs based on disruptive innovation. I guess the main concern would be ethical concerns for some of them, because I think they're invested in things like genetics and whatnot. But other than that, I am a fan from my research so far. What do you guys think?
Yeah. Okay.
Do you have any thoughts on ARK Invest? Have you looked into ARK Invest before?
Yeah, I've looked into them a little bit, and I think you'll probably have more to say on this than I do. I mean, I'm not I obviously like businesses that are innovating and pushing the boundaries, but generally I stay away from them in terms of investments, just because a lot of the time they attract these really high prices, and it's kind of the case where if you're investing in that business, if it succeeds in what it's aiming for, you'll make a ton of money. But if it doesn't, which is more likely than not going to be the case, you will lose money. And I don't like those bets. So in terms of an investment perspective, I kind of stay away from them. And I guess maybe you could balance the risk a little bit by investing in something like ARK, where you're getting a diversification of all of these innovative businesses. But it's just not, it's not something that I personally look into to invest. But I love following businesses like a Tesla that are just pushing the boundaries and forcing other companies to wake up and actually do things. So in that respect, I like it, just not as an investment.
And definitely when it comes to investing, like I'm the same. We obviously invest the same. When it comes to actually looking at investment opportunities, we like, thinking about cash flows and long-term histories of growth and blah, blah, blah. But at the same time, I kind of just like switching gears sometimes and just thinking about investing or potential investment opportunities from like big picture, let's think about, okay, so we're long-term investors. What's the world going to look like in like 30 years from now? And I kind of like looking at, like what you say, I kind of like looking at companies that are pushing the boundaries and are pushing us into the future. They are creating the future technologies now. I kind of just sometimes I like to get my head out of all the numbers and just think about big picture stuff, think about where is the world going? What are the technologies of the future and who's working on them? And ARK think that way. That's the way that they go about their investing. They are thinking about what is the disruptive innovation that's happening now, which pushes us into the future. I'm looking here, their different investment strategies are disruptive innovation, next generation internet, genomic revolution, autonomous tech and robotics, mobility as a service, space exploration, 3D printing, cryptocurrencies. So you can tell they're very much thinking. They're not thinking about what's going on right now. They're thinking about what's going to be happening in 30 years from now. And they're kind of, I guess their strategy is placing diversified bets while those companies are in their infancy, while this future tech is in its infancy, in the hope that as time goes on, their positions just explode and achieve high growth as the disruptive innovations that they think are coming do come true, I guess.
Yeah.
That's why they're obviously such big believers in like Tesla and Elon Musk, because Elon Musk is a CEO that thinks the same way that they do. Let's not think about investing, or let's not think about business as numbers. Let's think about what does the world need to change to over the next 10, 20 years. And let's innovate to make sure that reality occurs. And then the numbers should just follow. So it's kind of a different way that we think about investing. But I definitely wouldn't. I certainly still feel it's a valid way of looking about making bets, I suppose.
Certainly. I think it's just a different strategy. There's a lot of people who invest in that way, where you go really wide diversified and, in that group of 100 pushing the edge innovative businesses, maybe only one or two of them really go big, but maybe that's enough to offset
that's all you need.
The 98 or the 90 in that 100 that don't go anywhere. So it's just a different way of investing that I personally don't partake in at the moment, but maybe I will in the future. But yeah, very interesting. They're doing, it's been definitely a very interesting and different type of fund that's performing very, very well at the moment.
Yeah. Big bets on Tesla.
Yeah.
So hard to go wrong over the past couple of years.
Yeah, exactly right.
Anyway, so I think that's where we'll leave this one. We're kind of coming in right on the 1 hour mark. So hopefully next week we can get to some more questions. We do have a fair few questions to get through. So fortunately and unfortunately, I guess we've just been dominated with news stories, which is, I can't complain about that. It gives us stuff to talk about, which is very interesting. So, but anyway, yeah, keep sending in questions if you want us to feature a question or answer a question or send in a discussion topic. The way you do that is by leaving a comment on the YouTube version of the podcast. So head over to Young Investors Podcast on YouTube, find our most recent episode, leave us a comment, and then we just tally up all those questions and just chuck them into our Google Doc, and then we just work our way through them. So definitely to go and leave a comment if you want us to talk about something in particular, something has taken your interest about your investing over the last little while. Let us know. But apart from that, guys, that will just about do us for today. Thanks very much for listening. We certainly appreciate the hour of your time that you give this podcast every week, and we hope that it brings you value and it kind of gives you guys a bit of an insight into what we're thinking about the world. But I think that'll do us for today.
That'll do us.
All good?
All good.
That will do us. Thanks as always, Hamish, for joining me. Thanks Sharesight for sponsoring, and we'll see you guys next week.
See you guys.